Are you confused with all the information out there regarding investing and you want to get started, but you have no idea how or where to even begin? Well, that's our goal today, and you're going to leave this video knowing exactly what to do, what steps to take to become an investor. Hey guys, I'm Jay from Investonomics, and welcome to another video where we're going to talk about investing for beginners. So what we're going to do today is we're going to cover everything you need to know. Grab your notebook and pay close attention, because after this video, you'll be right on your way to financial freedom. When it comes to investing, there's so many polarized opinions, and you might have heard things like, oh, it's too risky and you'll lose everything in the market. Or maybe even traders saying, oh, you buy quick and sell quick and you can make a lot of money very quickly. As a matter of fact, they might even throw an ad at the start of this video just for exactly that. And these are things you should be careful of, but also not worry too much about, because these are outliers. This doesn't apply to every person. It's a select few people that have had these experiences. This is by no means something you should take their word for or take as law. In reality, investing really is a roller coaster, but if you take the advice and our tips from this video today, I can guarantee you'll be on your way as an investor. So the question then becomes, why do we want to choose the stock market as our investment vehicle over other things like, more commonly, real estate, GICs, which are guaranteed deposits at the bank, and things like holding money in a savings account? And the answer here is pretty simple. It has to do with Jerome Powell and the inevitable inflation. Savings accounts currently are paying disgustingly low interest rates. And although GICs are a little bit better given the current rates in the market, somewhere between 4 and 5%, this is still battling the current level of inflation, which is about 5% as of last quarter. So essentially, if you are investing in something that yields higher than inflation, you're losing money over time and becoming poorer. If you just have your money sitting in a savings account, you're making no money at all, and in fact, you're actually becoming less wealthy. And second, real estate is really difficult to get into for two main reasons. The first one is that as a beginner, you might be young or in your early 20s, maybe even your late 20s, and you don't have tens, hundreds, or even millions of dollars to throw into a home. And second, real estate is by no means passive. There are ways to do this in the stock market, which is beyond the scope of this video, through things called real estate investment trusts. But if you're investing in strictly physical real estate, there's a lot of maintenance that goes into it, a lot of ongoing costs. You have to deal with re-tenanting, all of those kinds of things make it not very passive and difficult to do alongside your 9-to-5 job. And finally, real estate is very concentrated in one asset area, which is real estate, and even more difficult is the fact that it is geographically not diversified either. Your house is in one place, so if the market for that area goes down, your asset goes down as well, which is your house. There are, of course, upsides to real estate as well, depending on how you use it. Again, beyond the scope of this video. Investing in the stock market then is kind of the obvious choice for every beginner, since you can start with whatever amount you want, and you have millions of options in terms of what you want to invest in, what companies you believe in, what sector you want to focus on. You can do this all through the stock market, and you can do it also all very passively as well. And most importantly, the stock market and stocks in general is the asset class that's outperformed every other asset in the last 90 years. So here's a quick stat for you. If you put $100 into the market in 1928, just into the S&P, which is a general stock market index, which we'll talk about in this video, you would have made a 42,500% return. So that $100 is now worth $42,500. And you know what's crazier? This is inflation adjusted. So this value is the true money you would have if you invested $100 back then. Okay, so now we know why we want to invest in the stock market. Let's break down exactly how you need to do this. So first things first, you have money in your bank account and you're wondering, okay, how do I even get started? I have this sum, what do I do? Do you go to the Apple website if you want to buy Apple stock and simply click buy on their website? No, actually that's not how it works. There's these things called brokerages, and in this day and age, they're very useful because they're actually just online. You used to have to go to a stockbroker or call your stockbroker in order to place a trade, but that's not the case anymore. Now we can simply go online to any of these brokers, and what a broker does is they take your money as a deposit from your bank account and they allow you to buy stocks alongside many other different kinds of investments on an exchange, and it links these two together. So a brokerage account is how you're going to place your trades to buy and sell stocks. So if you're from the United States, one of the most obvious options that you've probably heard of on other videos before is called Robinhood. It's super easy to use, it has a mobile app, and it's very user-friendly, so this is probably the best place to start. And once you get a little bit more seasoned, you can move to something like TD Ameritrade or E-Trade or even Fidelity that you can use to grow even more as an investor and learn more and have more tools at your disposal. If you're based in Canada, however, I would recommend something like Wealthsimple, very similar to Robinhood, but if you're looking to buy American stocks and indexes, I would recommend going to Interactive Brokers just because Wealthsimple charges an exchange fee when you're converting to and from US dollars. So this isn't quite that good, and it's about 3%, so it's pretty steep. So if you want to do this, use Interactive Brokers. That's currently the one I'm with. I'm in Toronto, Canada, so this is what I use. It's a very good broker. It's also can be very advanced, but it is very good, very low cost in terms of when you buy stocks and sell stocks, which is a great plus, and I would recommend that overall. If you're based in any other country in the world, do a quick Google search what the common brokers are in your country, which ones the best are, and which one offers the best pricing, and go from there. Okay, so now that when you've chosen your broker, there's going to be some kind of sign-up process. And we'll go through exactly how to do this in a different video, and you guys should comment down below if you want to hear exactly how to do this. I'd be happy to make another video explaining how to do this on Interactive Brokers. But essentially what it requires is your basic information, and if it's a registered account, which I'll mention in a moment, you will also have to verify your identity, your social insurance number or social security number in the United States, and you'll just have to verify some different income information and stuff like that in order to get started. And don't be worried about this, it's very standard, very normal practice. All these brokers, if you're choosing from the ones I mentioned, are very reliable and they are integrated within the system, so they're very safe. And finally, if you do choose to open a registered account, which includes a tax-free savings account in Canada or an RRSP, which we won't cover here, these are registered accounts with the government. In the States, this is a 401k or a Roth IRA. And these require you to associate a beneficiary with the account. So a beneficiary is someone that allows you to designate the amounts in your accounts and the investments to them when you die so that it won't get stuck in your estate when you die. Again, this is for a different video, but it will ask you to designate a beneficiary. Don't be worried about this. Just choose someone you know, their contact information. Very straightforward. Now, second, what I would like to mention is Interactive Brokers, when you sign up, you'll have the option for either an individual account or a tax-free savings account. And there's a very important difference here in that the tax-free savings account allows you to invest tax-free, meaning that any amount you earn on the amount you add to the account will not be taxed when you withdraw it. And again, this might be in the setup process, and if you can't find it, don't worry, you can do it in the settings after you're done as well. Once this is complete and you've set up your account, you're on the homepage, you can then deposit money to your account. Depending on the site you use, this might be a little bit different, but essentially all you have to do is link your brokerage account with your bank account, which might include just entering your bank details and then verifying it one way or another. But then you can deposit money into your account and you can get started. It's worth mentioning, however, that if you have a TFSA or a Roth IRA in the United States, that you have certain limits that you have to adhere by in terms of deposits. Of course, as a beginner, these limits will probably not be within reach. For me, for example, I'm 25. My limit's about $45,000 for my TFSA in Canada, so you likely won't reach this with your first deposit, but it is worth noting that there is limits for these registered accounts. If you do an individual account that's fully taxed, that's completely fine. You don't have any limits whatsoever. Once you got your money deposited into your account, and keep in mind, this might take a couple of days, and that's completely fine. Just give it the time to deposit. Once you see it in your account, you can get started. At Investonomics, I always advise everybody to buy low-cost index funds in your portfolio. It's one of the safest things to do. But first of all, what is an index fund? The second part of it is that it's a fund. So a fund is something that's run by a set of managers who run this fund, and they take different companies, pile them all together in terms of getting the best performance. Now, in terms of an index fund, they copy an index almost exactly. So for example, if you have an index for the top 500 companies in the United States called the S&P 500, they are going to take those same 500 companies in the same proportions into their fund to make it into an index fund. And of course, this takes very little management, and so there is very low fees. Three of the main indices that are copied by index funds is something like the S&P 500, which we just mentioned, which tracks the 500 largest companies in the United States. There's also the NASDAQ, which tracks technology companies in the United States. And you have the Dow Jones, which is mainly industrial type stocks. Of course, there's thousands of other ones for different countries and different sectors, but these are the three main ones. There are also various exchange traded funds. These are not based on indexes. And so these are called ETFs. You might have heard that word before. And so what these do is they take things from sectors and pile all these different companies to form that fund. So an example could be AI, where they have 50 companies based around AI and they make a fund around that, or something like farming or agriculture or mining, anything you can imagine, there's an ETF for it. So really, the investing world is your oyster. But if you do feel overwhelmed and there's too many options for you right now, which is totally understandable, I have three recommendations for you. So the first one is VOO, the second one is QQQ, and the third one is VTI. Now the first one, VOO, is an S&P 500 index fund. This one is very low cost and is a great way to get started. QQQ tracks the NASDAQ, again giving you that tech exposure, and VTI is the entire US stock market index. So these three give a very well-rounded start to your portfolio. And if you don't know what these three letters mean, it's simply called a ticker symbol, and it's how stocks and indices are actually tracked on the exchange. And you can use these to search them in the search bar on your brokerage account in order to find them and buy them. Now that we understand kind of the basics on how to get started, let's go through an on-screen example and I'll show you exactly what you need to do to buy or to sell a stock, some settings, and some special statistics that you should know before you start your investment journey. Here's kind of the home landing page of Interactive Brokers. This is an account I don't use as often, but we'll just use it here for this example. So again, at the top here, you can type either the name of the company or the ticker if you know it, but the name is fine too. It'll recognize what you mean. And here you can see my recent search history. I've already searched VOO, which is the one we're going to take a look at today. So when you click on it, you're going to get the stock's homepage, and this is an index fund, but it looks like it's a stock. So from that perspective, it's pretty nice. And you can see a bunch of different stuff, and this is super overwhelming if you're doing this for the first time. So the most notable thing we're looking at here is the price. And if you want to know where it's been in the past year, you can look right here at the 52-week, and you can see that we're very close to the all-time high in the last year, and we're pretty far off the all-time low. If you want to look at volume, simply what this means is how many shares or pieces of this index fund, or for a stock in that matter, and a share is, that's all it is. It's a small piece of a company that you're buying. How many of those were traded on a given day? So on the last trading day, I'm recording this on a Saturday, but on Friday, the total volume was 7 million. So this is pretty good. And it's a pretty good number if it's in the millions. And this means that 7 million shares were bought and sold on Friday. Now the chart here, don't worry too much about it. You can kind of see general trends. Again, if you want to go to the 5-year chart, you can see kind of the growth over that time. Can be interesting for you to look into, but not too important. And this is kind of where our buy and sell options are. So if you want to go in and buy, you can go right here, click buy. You can see the entire order window, and it doesn't look too complicated, and that's really nice. They don't overcomplicate it right off the bat. So again, here you can toggle between a buy order and a sell order, and you should never be using this. If you wait till the end of the video, I'll explain why, but always be using the buy order here. So all this really means, again, you can choose your account here, and you can choose which one you want to use if you have multiple. And the most important here is the quantity. So here it has 100, and right now it's depicted in shares. So if you want to buy one share, it's going to be the price that is depicted right here. But instead, if you want to do fractional shares, and this is the beauty, you can click over to USD here. And what you can do is you can simply buy $10 worth, and that'll give you 0.0254 shares of VOO. And this is awesome. So that means you can just put 10 bucks in and you don't have to worry about needing $393 to buy this one. So if you want to do that, I recommend always keeping the order type on market. This simply buys it at the most convenient time and the best at which it can fill at, which means it'll actually put your price on the exchange and put your order and fill it. This isn't too important right now. We will do a further video on this. There are various different kinds of order types you can use, but just stick to market and just keep this as day as well. It means at the end of the day, if your order isn't filled for your trade, which is unlikely, it will just cancel the order, but good till cancel will continue until you cancel it, or it's filled, whichever comes first. And then once you're done that, all you have to do, click submit buy order, and it'll give you a couple of warnings, and I won't do it here, but it'll just show you an order confirmation for the amount and the amount of shares that you've bought. So very simple and very easy to do on here. There's also a phone interface, which is even easier to use. So now that we've done all of this and we understand everything we've just gone through, you might be thinking, why do you want me to buy an index instead of just buying my favorite companies? I really like just having Apple and Tesla and maybe Nike in my portfolio, and that's really it. I don't really need anything else. The answer really comes down to risk. So you might have heard the word diversification or diversify your portfolio thrown around a lot, and this rings very true. What it means is that you should be diversifying over a broad amount of companies and possibly even in regions in order to manage your risk. And the reason this is the case is because if one company, say you buy Apple, if Apple goes bankrupt, you lose all of your money if you put your money into Apple. But with an index fund, Apple is just one of 500 holdings if you're buying the S&P 500 index fund. And so if Apple fails, they'll simply reduce the price of the index just a little bit, but then if it underperforms, the managers will remove Apple and replace it with a better performing company. So it's really a beautiful thing. It's done all for you, and there's not really a way to lose in this scenario. And of course, if you really wanted to, you could recreate the index yourself by buying all 500 companies in the exact proportions that the index does to recreate the S&P 500 or whichever other index. But again, this takes time and effort and is really tedious to do, so it's not worth your time. Okay, so now what you might be wondering is how much do you need to get started? There's a lot of stigma around this area. People thinking they need to add $5,000 a month, $10,000 a month in order to be an investor. No, complete bullshit. You can get started with as little as like $1 if you wanted to. Even $10. If you put $10 into your account every month, you can put it right into your brokerage account. Most accounts don't have account minimums. So if you just put that $10 in your account, you can just put $10 right into VOO and boom, you're on your way. And of course, the more you invest, the better it's going to be in the long run. So I'm not saying if you can afford it, if you can afford to add $1,000 a month, only do 10. But the more you add, the better it'll work in your favor. And this is due to something called compounding interest. And I'll leave a video right here that you can check out. That'll give you a good overview of what it does and how powerful it can be. Simply finish watching this video, get to it, set up your account, deposit some money, put your money in the market and let it work for you and forget about it. One thing I'd like to mention, especially for beginners, but also for seasoned investors, is the idea of management expense ratios and just expense ratios in general. You might be thinking, what the hell is that? Well, an MER is something that a fund uses to determine if it's low or higher cost. So an MER, as it stands, is the costs associated with the managers of the fund, so paying their salaries and compensating them for the time they use to balance the portfolio and change the investments within the portfolio, the administration costs, insurance, and other costs of running the business. And these are all passed on to us as investors. So for indexes, typically because there is a lower amount of effort needed to maintain it, they are lower cost. But we'll show you in just a moment exactly how to do this. And so now let's take a look at some on-screen examples of the fund's facts sheet. So you can always find the fund facts sheet by Googling the ticker symbol or the name of the actual fund, and then typing fact sheet right after it. And we can always see a page, which is the provider's website, disclosing the actual MER and the expense ratio. An MER should never be more than 1% for an index fund or ETF, and if it is, you should run right the other way and look for another one. Under 0.1% is amazing, and some are as low as 0.01%, such as some Vanguard funds. Vanguard, by the way, is a great place to discover new funds you might want to buy as well, and Global X offers some superior and great options for various ETFs, although again, you should watch those MERs. Some of those do go a little bit higher since they are higher management. The reason I'm so worried about MERs and why I'm putting such a big emphasis on this is, again, that compounding effect. So if you have a fund that's returning you 5% in a given year, the MER is calculated annually. So say if the MER is 1% and it subtracts that 1% from year 5, you're left with 4%. And this does not account for inflation. So realistically, this 1% is taken from you every single year, even if it's negative returns. If you return negative 5% that year, they're still taking the MER, so you'll be at negative 6. And again, this compounds. So over time, this can cost you hundreds of thousands, even millions of dollars based on the size of your account. It's better to be safe than sorry in this scenario, and always make sure you check the MER before you invest. One of the most important things that I will finish off with here is the idea to never sell. Regardless of what you hear, people day trading and all this stuff and buying pump and dump penny stocks and everything, that's not investing. That's trading, that's gambling. You want to be an investor. So if you want to be a true investor, what you have to do is buy, keep buying on a regular basis, and never sell your investments. This is the only way to make your money work for you and passively, and it snowballs into some incredible numbers over time. And even though it can be an emotional roller coaster, what I've tried doing and what's really worked for me is turning it into a game. So when the market falls really hard one day, or even over the course of a couple of weeks, I am actually really excited because I see, oh my God, it's on sale. These are actually super cheap now. My favorite stocks or indexes are on sale. It's like seeing your favorite chocolate bar at Walmart 50% off. So you can buy double the amount for the same amount of money.
It's free real estate.
And that's really exciting, right? So I usually load up when that happens, and when the market recovers, it grows exponentially because I do that. And even that $10 a month goes a long way. So even if you're adding $10 when the market's down, you're still buying a lot more than $10 would buy when the market is up. So this is really important to know. And if you have a lump sum that you have to invest, say you have an inheritance or you got some kind of big amount that you want to invest, there's a great video right here. Talks about dollar cost averaging, which is something you need to learn about as well if you're going to be an investor, versus lump sum investing. This is a really good video and kind of breaks down the importance of putting it all in the market and letting compounding work for you. So I hope this is a really informative video. Hope you guys learned lots, took good notes because you're going to need these in a minute. And after this video is done, close your laptop, go and, well, actually you should probably keep your laptop open, but close this window and go to your brokerage account, sign up, deposit your money, and get started as soon as you possibly can, because time is your best friend as an investor. As always, guys, leave questions or comments down below if you need any help with this, and have a great one. Feel free to subscribe if you like content like this.